On Monday, Canadian AI-adjacent stocks on the S&P TSX Composite found themselves caught between two of the largest AI capital events in a single trading day. Anthropic announced a confidential S-1 filing with the U.S. Securities and Exchange Commission, positioning the Claude developer for a potential public debut as early as this fall at a valuation of $965 billion. That number arrived on the same morning Alphabet confirmed an $80 billion equity raise to fund AI infrastructure, anchored by a $10 billion private placement to Berkshire Hathaway, while NVIDIA unveiled its RTX Spark superchip at Computex in Taipei, entering the personal computer market directly for the first time. The TSX opened under that backdrop, with Canadian AI-adjacent names drawing fresh attention from BNN-Bloomberg and Kalki media analysts, tracking spillover effects from U.S. AI momentum. On the surface, the day looked constructive. NVIDIA's stock climbed as investors absorbed the RTX Spark news, and the AI rally lifted Wall Street indices toward new records, despite a separate oil surge tied to Middle East risk. Alphabet shares fell nearly 2% in after-hours trading following the equity raise announcement, a dilution reaction. But institutional anchoring by Berkshire signaled that the largest capital pools are still betting heavily on the AI infrastructure cycle, not stepping back from it. The Apotex IPO launched the same day, seeking up to $1.2 billion on the TSX in what would be Canada's largest life sciences listing in years. Evidence the domestic IPO window is genuinely opening. But Apotex operates in a different capital pool entirely. The AI repricing story and the Canadian generic drug listing are not competing for the same dollar. What they share is the broader message that Canada's capital markets are being asked to absorb and price discover across multiple large events simultaneously, at a moment when the country's GDP just recorded a second consecutive quarterly contraction.
Anthropic's revenue trajectory is the detail that changes the picture. The company's annualized revenue run rate was $4 billion by July 2025. By January 2026, it had passed $9 billion. Anthropic has told investors the run rate will exceed $50 billion by the end of July, an 80-fold increase over 2 years. For the second quarter of 2026, the company projects $10.9 billion in revenue, more than doubling the $4.8 billion it generated in Q1 and exceeding its entire 2025 annual revenue in a single quarter. The company is on pace for its first profitable quarter, with a projected operating profit of $559 million. At $10.9 billion in projected Q2 revenue, the $965 billion valuation implies roughly 22 times annualized revenue. If the $50 billion run rate materializes by July, that multiple compresses to 19 times. Those are the reference multiples that institutional investors now carry into every AI-adjacent name they hold or evaluate, including names trading on the TSX. The unstated premise embedded in how TSX AI-adjacent stocks have been priced is that the Canadian market doesn't need a direct revenue comparator for AI. That proximity to the AI wave, through data center exposure, semiconductor distribution, or enterprise software contracts, is sufficient justification for the valuation premium those names carry. Anthropic's S-1 filing, even in confidential form, breaks that premise. It does not do so by suggesting Canadian AI-adjacent stocks are overvalued in absolute terms. It does so by introducing a concrete benchmark. An AI company growing revenue 80-fold in 2 years, generating $10.9 billion in a single quarter, and trading at 19 to 22 times annualized revenue. Every TSX name that has risen this year on AI sentiment now sits next to that benchmark, whether its management teams intended it to or not. The participant timing asymmetry is already visible. U.S. institutional buyers, the same pools represented in Alphabet's $80 billion raise and Berkshire's $10 billion placement, moved first. Goldman Sachs, JP Morgan Chase, and Morgan Stanley are expected to anchor Anthropic's listing. Canadian institutional holders of TSX AI-adjacent names are in a different position. They have not yet received the prospectus disclosures, have not seen the audited revenue figures, and are pricing exposure based on yesterday's reference frame. That is not a judgment on their positioning, it is a description of where the information asymmetry currently sits. The observable gap between who has moved and who has not is the live question the next few sessions will answer. The condition that validates the current TSX premium is straightforward.
If Canadian AI-adjacent companies can demonstrate enterprise revenue growth that keeps pace with the global AI capex cycle, evidenced by the Alphabet $180 to $190 billion capital expenditure plan for 2026, and the broader $700 billion in AI capex expected industry-wide, the premium survives repricing. If those companies' revenue trajectories prove disconnected from the capex wave, the Anthropic benchmark becomes an argument for compression rather than continuation.
The unresolved question from the previous layer is not whether Anthropic will successfully list. It is whether the valuation multiples its listing implies will hold long enough to inform how Canadian investors hold or reduce AI-adjacent exposure before the S-1 becomes public. Anthropic's confidential filing sets up what could be the most significant cluster of technology initial public offerings since the dot-com era. OpenAI is preparing its own confidential filing and has targeted a public debut at a potential valuation of up to $1 trillion. SpaceX has already filed for what analysts describe as the largest IPO in history, with marketing set for early June. All three companies are backed by overlapping pools of sovereign wealth and institutional investors. Goldman Sachs, JP Morgan, and Morgan Stanley are expected across all three listings. That is a meaningful concentration of underwriting bandwidth and institutional allocation capacity pointing toward a single fall window. The historical parallel that applies here is not the dot-com peak itself. Anthropic, OpenAI, and SpaceX have real, rapidly growing revenue, which 1999-era listings generally did not. The more useful parallel is the 2014-2015 period, when Alibaba's $25 billion IPO, then the largest in history, temporarily pulled allocation capacity away from secondary market positions in the same sector. The question for TSX AI adjacent names is whether the fall IPO window draws Canadian institutional capital toward primary allocations in Anthropic and away from secondary TSX positions, or whether the two pools are sufficiently separate that the reallocation doesn't reach the TSX at all. The verification benchmark is concrete. Anthropic's S-1 will become public after the SEC review completes, disclosing the audited revenue figures and the Pentagon supply chain risk designation that stems from the company's refusal to grant the U.S. military unrestricted model access. That disclosure is the moment when the 22 times revenue multiple either looks defensible or doesn't. If it looks defensible, if the $10.9 billion Q2 revenue figure and the $559 million operating profit are confirmed in the public filing, the benchmark becomes a floor that lifts the valuation frame for every AI name in the portfolio, including TSX-listed ones. If the numbers are revised downward, or if the Pentagon designation proves a larger contractual risk than the private market priced, the benchmark becomes a ceiling instead. The lean here is that the TSX AI adjacent premium survives the short term. The Alphabet $80 billion raise and Berkshire's participation are observable signals that the largest institutional pools are not retreating from AI infrastructure exposure. But the medium-term question is whether that premium holds once Canadian investors have the Anthropic prospectus in hand and a revenue multiple to compare against. The invalidation condition is not simply a failed listing. It is a scenario where Anthropic lists successfully, but TSX AI adjacent names cannot demonstrate they sit on the same revenue transmission path. Because if the listing succeeds on Anthropic's own merits, it removes the borrowed valuation halo that Canadian proximity plays have been trading on all year. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.